A deeper look into the Conceptual Framework 2018. Hi there, my name is Jerry Mutimukulu, and I am the ACCA instructor at Transkyle Business School. Transkyle is an online ACCA tutoring school that has been around for a very long time and has a great track record of generating ACCA trainees who perform well. You can reach me by phone at +263 7745 96368 or by email at transkylex@gmail.com. We will delve deeply into the 2018 Conceptual Framework in this video. Renovating a building can often prove to be a complex and daunting task. Initially, you may identify certain areas in need of upgrades, but as the renovation progresses, additional issues may come to light, potentially extending the project timeline and scope beyond your initial expectations. Similarly, in March 2018, the International Accounting Standards Board, IASB, completed its renovation of the Conceptual Framework for Financial Reporting, the Conceptual Framework, which had undergone revision in 2010. Comparable to a building renovation, the IASB faced the challenge of balancing necessary updates with the potential ripple effects on existing International Financial Reporting Standards, IFRS standards. Despite this consideration, the IASB published a revised version of the Conceptual Framework in 2018, prompting examination of the significant changes implemented. Chapter 1: The Objective of General-Purpose Financial Reporting. A refined focus. In contemplating the objective of general-purpose financial reporting, the board reintroduced the concept of stewardship. Though seemingly minor, this adjustment reflects stakeholders' emphasis on the role of management in stewarding resources, a notion inherent in previous versions of the Conceptual Framework and financial reporting practices. But, before we go any further, let's look into the main purpose of the Conceptual Framework. The purpose of the framework is to assist the IASB to develop and revise its standards. Assist entities to develop consistent accounting policies when no standard applies to a particular transaction or other event, or when a standard allows a choice of accounting policy, and assist all stakeholders to understand and interpret the standards. However, it should be noted that the International Financial Reporting Standards, IFRS, take precedence over the framework. Should new IFRS depart from the framework, the IASB will explain the reasons and the basis for conclusions on that standard. As already been highlighted, when considering the objective of general-purpose financial reporting, the board reintroduced the concept of stewardship. This is a relatively minor change and, as many of the respondents to the discussion paper highlighted, stewardship is not a new concept. The importance of stewardship by management is inherent within the existing framework and within financial reporting, so this statement largely reinforces what already exists. Users base their expectations of returns on their assessment of the amount, timing, and uncertainty of future net cash inflows to the entity, and management's stewardship of the entity's resources. Stewardship can generally mean accountability, although in the spirit of the Conceptual Framework, this goes beyond that. Zeff, 2013, cited in Cordery and Sinclair, 2016, notes the concept originally required merely a report of management's honesty in husbanding the enterprise's resources. Later it required reporting on management's efficiency, Zeff, 2013, cited in Cordery and Sinclair, 2016. It now encompasses analyzing management's ability to generate a suitable return on the resources employed. See IASB Conceptual Framework 2018 Paras 1.22 to 1.23, where reporting on the efficiency and effectiveness of management is considered to help users assess management's stewardship of these resources. Such an assessment is rooted in ex post reporting, Murphy et al., 2013, cited in Cordery and Sinclair, 2016. Anyway, this is a meal for another day. Chapter 2: Qualitative Characteristics of Useful Financial Information. Maintaining Essential Elements. Originally intended to remain untouched, this chapter saw revisions following responses to the discussion paper. Preserving Core Traits. The framework outlines the qualitative traits of practical financial data. These features are, nevertheless, subject to financial limitations. Therefore, it's critical to assess if the advantages of the information to consumers outweigh the expense borne by the organization that provides it. The framework makes clear what constitutes relevant and accurate representation of financial information, which are the two requirements for information to be considered valuable. The two fundamental qualitative characteristics are still faithful representation and relevance, whilst the four enhancing qualitative characteristics are timeliness, understandability, verifiability, and comparability. Let's start by discussing relevance. Relevant financial information is information capable of making a difference in the decisions made by users. Thus, this is information capable of influencing decisions. Information may be capable of making a difference in a decision even if some users choose not to take advantage of it or are already aware of it from other sources. Financial information is capable of making a difference in decisions if it has predictive value, confirmatory value, or both. Whether or not financial data itself functions as a forecast or prediction, it has predictive value if it can be applied to user activities to predict future results. Users use this information to create their own projections. Furthermore, financial data has confirmatory significance when it provides commentary on previous analyses, modifying or validating them. Information with predictive value frequently also has confirmatory value, demonstrating the connection between the ideas of predictive and confirmatory value. For example, historical revenue projections can be compared with current year revenue data, which is used to estimate future revenues. Based on past results, these comparisons help users improve their prediction procedures. This takes us to the concept of materiality. Materiality in financial reporting pertains to information that, if omitted, misrepresented, or obscured, could reasonably affect decisions made by the primary users of general-purpose financial reports regarding a specific reporting entity. It's essentially a company-specific aspect of relevance determined by the nature or magnitude, or both, of the items related to the information within the context of that entity's financial report. Due to its entity-specific nature, the board cannot establish a standard quantitative threshold for materiality or predefine what might be considered material in any given circumstance. Now, faithful representation. Financial reports convey economic phenomena through textual descriptions and numerical data. For financial information to be beneficial, it must accurately represent relevant phenomena and faithfully reflect their substance. While in many cases, the legal form of an economic phenomenon aligns with its substance, discrepancies between the two mean that solely providing information about the legal form would fail to faithfully represent the economic reality. A faithful representation entails three characteristics: completeness, neutrality, and freedom from error. Though perfection is rarely achievable, the objective is to maximize these qualities to the extent possible. Completeness involves including all necessary information for users to grasp the depicted phenomenon fully, encompassing descriptions, numerical depictions, explanations, and relevant factors affecting quality and nature. Neutrality ensures information is unbiased, not manipulated to elicit favorable or unfavorable reactions from users. Prudence, exercising caution under uncertainty, supports neutrality by preventing overstatement of assets and income or understatement of liabilities and expenses. Faithful representation does not imply absolute accuracy but necessitates a depiction free from errors or omissions, with processes selected and applied correctly. Even estimates, subject to measurement uncertainty, can provide useful information if clearly described and explained. Despite uncertainty, reasonable estimates contribute to the preparation of financial information without diminishing its usefulness. Please refer to your study notes for explanations on the four enhancing qualitative characteristics: timeliness, understandability, verifiability, and comparability. While the fundamental qualitative characteristics relevance and faithful representation were retained in the Conceptual Framework 2018, explicit references to prudence and substance over form were reinstated. This decision was prompted by stakeholders' concerns regarding the omission of these concepts in the 2010 Conceptual Framework, reaffirming their significance in ensuring accurate financial representation. However, care needs to be considered here owing to the issue of asymmetric prudence. As is often the case with a building project, making one minor change may lead to others, and everyone wants a building that is level. The problem with adjusting the building blocks here, even slightly, was that by adding in the reference to prudence, the board encountered the further issue of asymmetry. Many standards, such as International Accounting Standard, IAS 37 provisions, contingent liabilities and contingent assets, apply the system of asymmetric prudence. In IAS 37, a probable outflow of economic benefits would be recognized as a provision, whereas a probable inflow would only be shown as a contingent asset and disclosed in the financial statements. Therefore, two sides in the same court case could have differing accounting treatments despite the likelihood of the payout being identical for either party. Many respondents highlighted this asymmetric prudence as necessary under some accounting standards and felt that a discussion of the term was required. Whilst this is true, the board believes that the conceptual framework should not identify asymmetric prudence as a necessary characteristic of useful financial reporting. The 2018 conceptual framework states that the concept of prudence does not imply a need for asymmetry, such as the need for more persuasive evidence to support the recognition of assets than liabilities. It has included a statement that, in financial reporting standards, such asymmetry may sometimes arise as a consequence of requiring the most useful information. Chapter 3, Financial Statements and the Reporting Entity. Establishing boundaries. Previously labeled as to be added, this chapter now addresses the description and boundaries of a reporting entity, defining it as an entity choosing or required to prepare general-purpose financial statements, a subtle yet pragmatic addition. Chapter 4, The Elements of Financial Statements. Defining assets and liabilities. Undergoing alterations akin to repainting walls, the definitions of assets and liabilities were modified, triggering substantial discussion within the accounting community. The definitions are restated here. 1. Asset, of an entity. The 2010 definition of an asset was, a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. However, the Conceptual Framework 2018 defines an asset as, a present economic resource controlled by the entity as a result of past events. An economic resource in this regard is defined as a right that has the potential to produce economic benefits. 2. Liability, of an entity. The 2010 definition of a liability was, a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. However, the new framework defines a liability as a present obligation of the entity to transfer an economic resource as a result of past events. The supporting concept here is that, an entity's obligation to transfer an economic resource must have the potential to require the entity to transfer an economic resource to another party. Accordingly, the term obligation is defined as a duty or responsibility that an entity has no practical ability to avoid. Chapter 5, Recognition and Derecognition. Enhancing recognition criteria. A departure from the 2010 conceptual framework, the revised approach to recognition prioritizes the qualitative characteristics of financial information. This shift eliminates the previous probability criterion and offers a more nuanced perspective on asset and liability recognition. The probability criterion has been removed as different financial reporting standards apply different criterion. For example, some apply probable, some virtually certain, and some reasonably possible. This also means that it will not specifically prohibit the recognition of assets or liabilities with a low probability of an inflow or outflow of economic resources. This is potentially contentious, and the 2018 conceptual framework addresses it expressly in Chapter 5, paragraph 15, which notes that an asset or liability can exist even if the probability of an inflow or outflow of economic resources is minimal. The main element here is about relevance. If the event is unlikely, this may not be the most useful information. The most significant information may be regarding the item's potential magnitude, timing, and probability influencing aspects. Even after expressing all of this, the conceptual framework concedes that elements like this are most likely to be included in the financial statement notes. Thus, basically, the board affirmed that an entity should only recognize an asset or a liability, and any related income, expense, or changes in equity, if such recognition provides users of financial statements with relevant information about the asset or the liability and about any income, expense, or changes in equity. A faithful representation of the asset or liability and of any income, expenses, or changes in equity, and information that results in benefits exceeding the cost of providing that information. Finally, a significant shift in Chapter 5 concerns derecognition. This was not previously addressed by the conceptual framework, However, the 2018 Conceptual Framework emphasizes that derecognition should attempt to properly represent both the assets and liabilities retained following the transaction or other event that led to the derecognition, including any asset or liability acquired, incurred, or formed as part of the transaction or other event. B. Any changes in the entity's assets and liabilities as a result of the transaction or other event. Chapter 6, Measurement. Broadening measurement bases. In a notable expansion, the 2018 Conceptual Framework introduces a comprehensive section on measurement bases, aiming to provide clarity and practical guidance to users. The measurement bases considered can be discussed here. First, historical cost. The accounting method remains intact, but the conceptual framework now specifies that the carrying amount of non-financial items held at historical cost be updated over time to reflect usage, by depreciation or amortization. Alternatively, the carrying amount can be changed to reflect the prior cost being no longer recoverable, impairment. Financial items kept at historical cost should reflect subsequent changes, such as interest and payments, in accordance with the amortized cost principle. The 2018 Conceptual Framework also describes three measurements of current value: fair value, value in use, or fulfillment value for liabilities, and current cost. Fair value continues to be defined as the price in an orderly transaction between market participants. Value in use, or fulfillment value, is defined as an entity-specific value and remains as the present value of the cash flows that an entity expects to derive from the continuing use of an asset and its ultimate disposal, or that an entity expects to be obliged to transfer as it fulfills a liability. Since current cost is an entry value, it differs from fair value and value in use. While fair value and value in use are exit values that concentrate on the values that would be gained from the item, this looks at the value at which the entity would buy the asset, or incur the obligation, at current market pricing. The conceptual framework not only describes these measurement bases but also addresses them in the context of the qualitative features of financial data. It provides some information in the form of examples to illustrate situations where specific bases might be more pertinent, but it does not advocate which bases objects should be carried under. Here, relevance is a crucial factor. According to the 2018 Conceptual Framework, historical cost is unlikely to offer pertinent information about derivatives and may not offer meaningful information about assets kept for an extended length of time. In both situations, it's likely that a modification of the current number will be used to give users more predictive data. On the other hand, the conceptual framework implies that if goods are held only for use or to realize contractual cash flows, fair value might not matter. In addition, elements utilized in combination to produce goods or services for clients in order to generate cash flows are particularly mentioned in the conceptual framework. A cost-based metric, in which the cost is compared to the profit margin on sales, is likely to yield more pertinent information because it is unlikely that these goods could be sold separately without penalizing the activities. Chapter 7, Presentation and Disclosure. Addressing presentational principles. A new addition, this section outlines principles for item presentation and disclosure, particularly focusing on the treatment of income and expenses in the statement of profit or loss. Resolving the recycling dilemma. Controversy surrounds the recycling of other comprehensive income (OCI) items, prompting deliberation over their inclusion in profit or loss statements. The IASB strikes a balance, advocating for recycling when beneficial, but refraining when clarity is compromised. Conclusion. While these changes may seem inconsequential to most preparers, they hold significant weight for ACCA candidates and the accounting community at large. Recognition and measurement alterations, in particular, are pivotal topics for examination in financial reporting and strategic business reporting exams. As such, I encourage you to download a copy of the Conceptual Framework 2018 from the course portal on our Google Classroom, and read it for your deeper understanding of these key issues. For the further reading on stewardship, please access the Cordery and Sinclair, 2016, article from the same place on the portal. You need to also use the notes supplied. Always do and submit your weekly assignments. Remember, after week 5, we will be having a mock test to assess how far we have mastered the topics covered. Until next time, please continue to feel excited. I mean, very, very excited. Thank you.